Hey Alf, how's it going, man?
Hey, Ro. Thanks for having me here.
Thanks. Thanks for joining. I know we've spoken online, but haven't ever done a space together, so appreciate it.
My pleasure.
Thank you, thank you. Let's give everyone just another minute, and then we can get started.
Good morning, Alf. How are you, my friend?
Hey, Doomberg. Yeah, that's gonna be a cool spaces. Thanks for joining. You can shed some light on the energy markets much better than I can, and I can try and complement that with whatever our smart policymakers are gonna try and react.
Yeah, it's been quite a few days, keeping us both busy, I'm sure.
Yeah, maybe we can get started. I mean, I wanted to keep this fairly general. There's many different topics, in the macro space around QT, of course, valuations, and just a lot going on from policymakers in general, like you highlighted, Alf. But maybe it makes sense to start with the energy side of things, given the current kind of news that have broke for the past, I don't know, 72 to 96 hours. Maybe if you want to just give a quick overview of Doomberg there, and then we can just kind of have a fluid conversation on all different topics, on macro energy, and just kind of take it from there. What do you guys think?
It's
I
fine
would
by me. Yeah.
I would defer to Doomberg when it comes to energy.
Yeah,
Clearly, the expert in the room. I'll try to
cool.
top it up.
Yeah, no, cool. So we can start there just for like a quick overview for people that probably don't even know what might have happened and the implications of that. And I'll
Yeah,
also pin a thread that I wrote up, which is I think it's simple enough to kind of follow along and see what's happening. So I'll pin that in the nest while you chat Bloomberg.
sure. I'll give a very, very high level summary. We put out a piece last Thursday called Dead of Winter, where we introduced the concept of the law of anti-logic, where we speculated that you could best predict what's going to happen in the future by assuming that the current slate of Western leaders would make the worst possible decision at every opportunity. And it was kind of a cheeky piece, meant to be a bit provocative and to have a little fun, let's say. And then Friday, we were privileged enough to participate in an Epic Spaces hosted by Grant Williams with Marco Popic and Luke Groman and myself. And then over the weekend, the news just exploded, as you can imagine, and we're covering this in a piece that we're putting out tomorrow. What's going on in Europe today, I would say, is reminiscent of the rolling series of bailouts needed in the 2008-2009 global financial crisis, except this time it is electricity power producers who are being bailed out to the tunes of tens of billions, which is kind of analogous to us at least, and maybe Alf could have some insights on this. The bailout of AIG to save the investment banks from the famous peak moment of crisis back in 2008. Really, the bailout of the power producers is a de facto bailout of the European banks, and it remains to be seen whether that bailout will be sufficient. We suspect it won't. We suspect this is sort of the beginning of many dominoes soon to fall. And we should say we have been writing critically about global energy policy and a focus on its genesis, which was in Europe last year for the better part of a year. We take no pleasure in watching these events unfold. It is a true catastrophe, and the consequences of that catastrophe will be felt by those in the global society, because the consequences won't be limited to Europe, who can least afford it. And we're seeing that today with continuous spikes in inflation. And then now, of course, we're beginning to see government stimulus, which is just fuel that's going to be poured onto the inflationary fires that are already burning in Europe. The new Prime Minister of Great Britain announced or leaked overnight that she's looking at somewhere around 175 billion British pounds, which I saw somebody reference today was roughly 5% of British GDP in transfer payments to offset the increasing costs of personal and small business energy bills. And so it's a real challenge. I think that plus, we saw Germany announcing 65 billion euros of similar payments to be partially funded by windfall profit taxes, quote unquote, on energy producers. It's a real sad and stressful situation in Europe, and really is, I think, reminiscent of 0809. We shall see how it all plays out. So that's the summary from me. Raul, I'll turn it back over to you.
Awesome. Alf, do you want to comment anything? Because I think you actually stay in the Europe area, and just kind of given more on the macro side, obviously this is going to have many effects that we're going to see play out in the next coming weeks or months. You want to make any comments from a macro perspective?
Yes, I want to actually comment on what Doomberg said. By the way, yes, I'm in Europe, basically in Italy most of my time. Doomberg made a comment on bailouts to just stress out the proportion of the problem we have in Europe. And today there was an article that went around and said that the margin calls that energy producers are going to face because of higher energy costs and in general other companies utilizing energy as a production input is roughly $1.5 trillion equivalent. So we're talking about a very large amount. And the governments here in general, policymakers have a very tough decision ahead. I compared big picture, the European situation to an exogenous external shock that emerging markets often face. Emerging markets are generally dependent from developed markets when it comes to something. Most of them are dependent because of the dollar. They choose to set up their dollar funding in a way that in case trade flows or they stop or they can't sell goods good enough, let's say, to service their dollar liabilities, they have a problem to service those in dollar, or they can be dependent because they need an external input that they cannot produce themselves. Well, Europe has effectively decided over the last 10 years to make themselves as dependent as possible from Russian natural gas and in general from energy coming from the outside. And Rahul, when you are dependent basically from an external input that you cannot solve by monetary or fiscal intervention, you are basically in an emerging market crisis conundrum where whatever policymakers choose to do now when it comes to monetary and fiscal policy, they'll always be wrong, or they will basically be able to act and put a band-aid on one problem and they will immediately see the pressure being released from another release valve. So take the European Central Bank right now. On Thursday, they have an interest rate decision to make, and the market was forcing them to try and think about a 75 basis point hike, which will be the single largest hike since the Bundesbank. I mean, we're talking about before the eurozone, the euro area setup. Today, there are leaks that the European Central Bank won't hike by 75 basis point. It will only hike by 50 and then consider 75 basis point later on. So if the European Central Bank now decides to not hike very aggressively in order to protect financial markets and to not tighten conditions aggressively for a hyper-financialized economy, they will have a serious problem when it comes to their currency, because investors will not take them seriously when it comes to fighting inflation. As real interest rates are not pushed up aggressively, the release valve will be the currency. Now, let's assume instead they hike by 75 basis points, and then they will have to continue hiking and be very aggressive and try to stop the euro from depreciating via increasing real interest rates. The conundrum they face is that they will make conditions very, very harsh for the private sector and for financial markets, and they will generate a negative wealth effect that will ripple through the economy and kill consumer confidence further. So I'm basically describing a situation where policymakers are at the forefront when it comes to having to take decisions right now. But because this is an exogenous shock, similar to what an emerging market often faces, it's very uncommon that a developed market has to face such a problem. But this is exactly where Europe is today. And whatever choice they go with, it has negative long-term implications.
I just have to say, I really appreciate your framing of it in that way, Alf. I completely concur, and I think it is a brilliant and appropriate analogy for the current situation. So really, really great way to frame it, and fills in a few holes for me. So Raul, back to you.
Yeah, no, that was really good, and I like how you kind of summed it up and connected all the dots there. And the point you make about the 75 bips is it's similar in the U.S. too, right? I think 75 bips in that we had over summer was the largest rate hike since '94. The only kind of scenario you can compare kind of what's happening here in U.S. central bank policy is 2018 when we had a series of 6 hikes, but they were all 25 or 50 bips. So 75 in general, like you said, is a large hike given kind of monetary easing the past decade or so globally, or even longer, you can argue. So that's definitely something to. You said that's. I think that is this Thursday, right, Alf? I think that meeting is coming up this Thursday with the ECB decision.
Yeah, that's correct. It's going to
Right.
be this Thursday.
So let me ask you this, and again, sorry to kind of another energy question, but just given the implications of this, it's probably worth asking for the audience. Probably is concerned. Doomberg, given that this is happening now. We've talked, I think, on a space before about kind of the winter being tough in Europe, and of course, people having challenges, possibly heating their homes and things of that nature. I mean, given what's happening here, along with what we were already seeing possible for winter, how do you think that changes the situation? Given this news that's hit in the past, I don't know, couple of days.
I assume you're referring to the news of the indefinite shutdown of Nord Stream 1.
Yes, yep, that's right.
So,
which, by the way, just before you start, I highlighted in this thread above, pinned, just because when this happened, even myself, I didn't fully understand what it exactly meant. And I think for the audience, it's important to understand this route, the Nord Stream route, delivers more than 1/3 of Russia's gas export to Europe last year. And that's why it's so important, because it's shut down now indefinitely. And I think it was shut down for maintenance over summer. So it's all right in this thread above. I think it's an easy process to follow what's going on. But go ahead, Doomberg.
yeah, well, I mean, Putin has made clear what many of us have been speculating, and some in Europe are complaining, that he has decided that he is going to use the leverage that has been handed to him over the 10 years plus that Alf was referring to in his opening comments. And so just to frame it, Nord Stream 1 is one of the main ways in which natural gas has flowed historically from Russia to Europe. Another, of course, is through the pipelines in Ukraine. And as far as we know, those are still delivering some natural gas from Russia to Europe. So natural gas has not been completely shut down, but Nord Stream 1 has been shut down indefinitely. And the battle really is over sanctions. And somebody from Putin's administration, who I forget, was out yesterday saying that effectively there will be no gas flowing through Nord Stream 1 until the collective West drops their sanctions against Russia. We don't view that as a very high probability event. And so the situation for energy in Europe in the winter of 2022, 2023 just got a lot more precarious. And so it's very difficult to imagine scenarios now where rationing of energy isn't implemented. And the question becomes, what is the mechanism of enforcing such rationing? We're not yet seeing signs of people in policy making positions realizing the true extent of the crisis, although I suspect that the forced bailouts of several electricity producers over the weekend will begin to wake people up. But this is where, as we'll describe in our piece tomorrow, the handing out of stimulus, which is obviously feels like the right thing to do, and in many ways it is a humanitarian thing to do, only puts off the rationing decision, only elevates the price at which that decision will have to be implemented, ensures that that decision will be highly inefficient, and really is going to have potentially catastrophic consequences for the inflationary fight that the ECB is embarked on. And so this is really as Alf so brilliantly framed it, an emerging market exogenous shock type assimilation here is probably the best framework. And when you have no good decisions before you, as Alf said, it's pretty easy to characterize any decision you make as a bad one, sort of I guess a macroeconomic zugzwang. So yeah, this was the big development over the weekend. It actually broke, I think, about an hour before we jumped on that Twitter Spaces on Friday, and then we saw this amazing series of headlines. I mean, you remember when it seemed like every weekend in New York you would wake up in 2008 to another literally unbelievable headline. Shotgun marriages of investment banks on the brink of collapse. The government not bailing out Lehman Brothers, only to turn around and bail out AIG 3 or 4 days later. It feels like every day we wake up here in this crisis with a similar set of, heretofore unthinkable sets of headlines. And it really is amazing to watch in real time.
Yeah, I was gonna say when you compare it to '08, I'm in the New York area, so I vividly remember that. And the point you make about this crisis, I think in summer when we were talking about this, outside of kind of some of the people that really follow the energy space, I think people thought calling it a crisis was a bit maybe exaggerated, but I think you can truly kind of see it as a crisis now, given the series of events, and I think this is truly concerning. So something to definitely monitor. And yeah, Doomberg covers energy really well, so if you're not already following him, give him a quick follow. But Alf, coming over to you, kind of let's shift gears a little bit. A lot going on from a macroeconomic perspective. Rate hikes we touched on. I think QT ramps up this month to about 95 billion, um, which I think economists say usually takes 6 to 9 months to really kind of see the effects in the system. Um, and you've seen kind of the past few days before this kind of 3 day holiday we had, the market started really taking a hit. I think we took out August gains in a matter of 2 days. So just kind of what do you feel, do you think that we see another test of June lows again? No one has a crystal ball, but me personally thinks that's truly possible, right? I mean, I think QT really is gonna have some effects that many of us can't really price in, let's call it that way. But what are your thoughts there on QT? You have the ECB decision this Thursday, but you also have a rate hike coming from Powell later this month, and he was pretty, say, fairly hawkish in Jackson Hole. I mean, hawkish enough to hit the market. So, what are your thoughts there?
So Rahul, the first thing is to always measure your macro take against what's priced in right now. So when we talk about hikes, we should look at what the forward curve is already pricing in. So let me go on Bloomberg and tell you live what are we looking at today. So today in the US, we're looking at roughly by December, Fed funds rate to be at 3.65%. And for reference, spot is about 238. That's the middle point between 225 and 280. So it's effective Fed funds rate. Effective Fed funds rate are priced to be roughly 125 basis point higher than today. So 125 basis point hikes are already in the forward curve. And then if we go, say, 1 year ahead, so we're looking at September 2023, we are looking at 383 as Fed funds. So basically, we're almost pricing in 4%, almost there in terms of pricing. So that's when it comes to what the market is expecting from the Fed, which I think is a very credible path of Fed funds close to 4%, which are relatively high and pretty restrictive. And those Fed funds to effectively been held there for almost all the way through 2023. So again, if you want to look at short-term bonds or the effect that they will have on the broader market, you are facing this pricing already. Now, when it comes to inflation expectations, that's the other thing which is important. The market is also expecting inflation to fall very fast. It's expecting inflation to be roughly at 3% in 1 year from now, 1 year, 1.5 years from now, and we are spot at 8.5. So it's quite a vertical drop, which is already priced in. Effectively, we're pricing a real Fed funds rate to be positive in about a year from now, which historically meant a relatively restrictive, empirically restrictive stance from the Federal Reserve. Over the last 75 years, the Fed has never stopped hiking until observed real Fed funds rate were in positive territory. The market believes that this time won't be different. But all I'm saying is that this is already priced in. Now, what is not priced in, I think, is the extent of the earnings slowdown. If I look at earnings per share, analyst consensus across sectors, they have come down a little bit from the top, but we are still looking at double digits growth over the next 12 to 15 months. And given the pressure that many sectors are facing because of either energy or input costs or margin squeezes, or because of tighter conditions that will affect these sectors, maybe with a lag, because a high yield over leveraged company can sort of kick the can down the road in issuing debt for as long as the forced rollovers of their liabilities come through. But at some point, these tighter financial conditions will have to affect earnings and operating leverage from these companies as well. And I don't think that's fully appreciated by markets yet. But when it comes to what real rates are priced in and what kind of restrictive Fed policy stance is already priced in, I think you have to look at the market in an objective way and understand that quite a lot of tighter financial conditions are priced in already. QT, it's a thing that is very different and difficult to measure as how much it's priced in or isolate as a macro variable. I would only say that about QT is that so far, especially over the last 2 months, 1.5 months actually, QT normally should, of course, reduce the asset side of the Federal Reserve balance sheet, but it should also reduce the liability side, clearly, of the Federal Reserve balance sheet, which is not only made of bank reserves, but also made of reverse repo and the Treasury General Account. And those are very different things, and they have a different impact on financial markets, because if you are able to keep bank reserves intact, interbank liquidity remains relatively high, and this interbank liquidity tends to support, to a certain extent, risk-taking and the ability to recycle this liquidity in the financial system. And over the last month and a half, the Treasury General Account has taken the brunt of most of the quantitative tightening, which has effectively led to bank reserves not being affected by the quantitative tightening process, which has been translated in relatively resilient markets, especially throughout July. Now, going forward, as the Treasury General Account has already been reduced to what historically is a relatively low level, and reserve repo money has a very hard time getting out of the trap it is because of the absence of bills issuance effectively, the only item left on the Federal Reserve liability side to take the brunt of quantitative tightening is exactly bank reserves, which are the item that tend to correlate the most with financial market repricing, because as banks have less interbank liquidity available, they will be much more reluctant in recycling this liquidity into riskier asset or riskier repo activities. And that normally escalates through credit spreads first and then through equity valuations later on. So overall, if I put everything into one balanced assessment, despite equity markets, shorts are definitely less attractive than they were at the beginning of the year. I still think the path of least resistance from here, or my base case, is to tilt towards a pretty defensive stance, especially in cyclical sectors where I think the earnings drawdown we are going to be seeing over the next 12 months is going to be more harsh than what analysts expect. And if you add on some liquidity pressure, which is going to intensify from the QT perspective, it could lead to some further repricing in the equity space.
Yeah, no, completely agree with you. Earnings, I think Q3 certainly is going to be tough. Margins compressing, given the cost of capital going up and the dollar strengthening, which I think is another big thing to follow. And QT really kind of affecting liquidity. You're spot on there, Alf. And I really like how you're kind of connecting everything each time you're kind of answering. So it's really helpful. Jeremy, I think you're on now. Any comments or questions to go from there?
Sure. Yeah, I just wanted to touch on a bit of the Federal Reserve's ability to front load monetary policy and tighter financial conditions. Back in July, we had credit spreads tightened back about 300 basis points, and the probability of a recession was priced in at about 10% into next year. So it seems as though the way I'm reading it is that the federal funds rate didn't do as well of a job as affecting financial conditions as market participants kind of hit in the long end of the curve. We had that 50 bips and flattener of the yield curve. It was quite inverted, and now I don't know if you guys saw, but last week there was about a 25 billion roll off on the balance sheet, which I believe was the second largest weekly draw since they've started with quantitative tightening in June. And with their monthly cap rate doubling in September to 90 billion per month, it seems as though QT is having more of an effect on the long end of the curve. As today, for example, I look at the 10-year, it's up, up to 3.3%. So the highest levels we've seen since late June. And Alf, I was just, wanted to get your take on, how QT affects the market pricing in tighter financial conditions for the long run compared to the federal funds rate?
It's a very valid question, and I think this is reflected in the real yield curve. So let's talk about that for a second. So if you look at what nominal yields are pricing, so real yields are, simply speaking, the difference between nominal yields and inflation expectations, not spot inflation, but the markets expect inflation to be over the considerable future. So the front end of the real yield curve is basically reflecting mostly the stance of the Federal Reserve, because nominal yields, especially at the very front end, 1 to 2 to 3 years especially, are very reactive to what the Federal Reserve will do or is promising strongly to do, right? Now, if the Federal Reserve is going to be very tight, as it looks like it's priced in the markets with almost 4% Fed funds, the obvious conditional reaction from inflation expectations is that those will fall because the Federal Reserve will have a grip on the market, on economies, will slow down demand, and ultimately it will manage to slow down inflation, maybe to a higher floor than before, but it will still manage to slow it down. So as real yields are the difference between nominal yields and inflation expectations, front-end real yields, so the one directly affected by the Fed, have actually repriced pretty aggressively. I think 2-year real yields are now pretty high, or as historically speaking, let's say 5-year real yields today are trading at almost 1% positive. And such a level has last been seen in, I think, 2018 at the peak of the tightening cycle in 2018. So this is when Powell said we were on autopilot. This is when Powell said there was a long way to go before even reaching neutral. This was when the market was believing the Fed could keep hiking. We are now at the same real yields implied by market in the front end as back then, which is, you can argue, a pretty decent tight stance. But now your question is more about the long term, right? And how QT interacts with that. Now, if you look at instead where 30-year real yields are in the US, they have gone up, but they have gone up to an extent that is, let's say, it's an interesting extent, but it's still low, quite lower than it was in 2018. So in 2018, we went all the way to 1.5% in long and real yields. Now we are talking about still 1%. So what's happening here is that the long end of the nominal bond market, so 30-year nominal yields basically, are much more reactive to long-term structural factors rather than the Federal Reserve stance itself. And what it means is that the 30-year bond yield is nothing else than the future expectations for the next 30 years of real economic growth and inflation, plus a term premium. Now, if the Federal Reserve overdoes things now, over-tightens today, so compounds the already cyclical slowdown we're seeing, the bond market in nominal terms is going to expect that the damage done to the economy today will be reflected over the foreseeable future, together with the the headwinds that growth and inflation are already facing due to aging demographics, due to technology, etc., etc. So what this is going to do is, contrary to many people's intuition, if the Federal Reserve tightens aggressively, kind of breaking the back of inflation today, it generally reflects in lower potential for higher bond yields later on. So this is why the curve inverts. This is why a very tight Federal Reserve today isn't managing to push 30-year bond yields to 4%, but the curve keeps inverting every time the economy shows signs of slowdown and the Federal Reserve keeps tightening further and further in a marginal basis. Lastly, QT, which is also believed to be a higher bond yield phenomenon, tends to instead, as I think I put out a pretty long thread on Twitter once about that, if people want to look it up, QT tends to flatten yield curves and long-term to lower bond yields. And that's again because as you restrict conditions short-term and you make the prospect for long-term growth and inflation worse, this is reflected in lower long-term bond yields and not in higher long-end bond yields. Temporarily, as you do QT, the private sector might have to absorb more supply. So if I'm a dealer and I know that a lot of bonds are coming my way, I'll have to make space for those, which means I'll have to be more selective when absorbing risk. I might demand temporarily higher yields to absorb the net supply coming from QT, but long term, because the economy takes a big hit from these tighter conditions, especially long-term bond yields tend to drop and the curve tends to flatten as a result of QT, not the opposite.
Awesome. Really appreciate that. I guess just a follow-up question. I know you touched on, 2-year, 5-year break evens in the United States and how long-term inflation isn't really priced into the markets, based upon the factors you already discussed, with tighter financial conditions in the short term, eventually leading to slowed growth, which tapers demand and then has a secondary effect on inflation. And, an interesting dynamic I'm seeing currently is the discrepancies between inflation expectations within the United States versus Europe. If you look at German inflation break evens, they're still quite elevated. And, much of that could be due to the fact that the ECB has been, one of the larger global central banks that hasn't really gotten started with their tightening cycle. For this time period, you have the ECB still has interest rates at 0% on the front end, although the market, has front run this. I think you're starting to see some reflectivity traits within the euro of the ECB's reluctancy to kind of get going. However, it seems as though there's some structural issues within Europe that, both of you guys have touched on. Doomberg does an amazing job at that, but that's obviously within the energy dependency on Russia. And although that might be somewhat of a binary effect, right? If, the news were to change tomorrow, let's say Putin were to be overthrown or, something along the extent of those lines, you would see this drastic, sort of rubber band effect within markets. But yeah, I just wanted to get your, opinions or, comments on maybe the discrepancies between where long-term inflation expectations are priced in between the United States versus the Eurozone.
I think that to answer some of this question, I will have to ask Doomberg's opinion about input costs for the Eurozone inflation market. And the reason why I'm saying that is that if you chart 5-year inflation expectations in Europe, also in the US to a certain extent, but if you chart them in Europe, especially over the last year and a half, against what's priced in for energy inputs, so natural gas, oil, anything that Europe needs and imports as an energy input for production, you can find a quite tight correlation. So it's an interesting thing that long-term inflation expectations in theory shouldn't be directly correlated with short-term energy inputs, but it tends to be the case that indeed they are. So the inflation swap market is taking a lot of hints from the energy market, even short-term, which then, if you want to have a perspective about these inflation expectations, you should have a view about input costs in the Eurozone. And obviously the central bank stance is very important for this series as well, but energy input costs are very important. So I'd like maybe to ask Doomberg to jump in and tell us what he thinks over the medium term Europe will have to pay in energy terms against what's priced in by markets today across the various energy inputs that Europe is using, maybe?
Yeah, it's obviously the single question and impossible to say with any definitive specificity what will happen. You could only look at what the market is pricing in to see what the sort of consensus view is. I do think we are sitting in a binary event. And I would ask you guys, once I'm done with my answer, how do markets generally price in binary events with extreme outcomes and fat tail risk? Historically during the financial crisis, for example, nothing mattered until it did all of a sudden. As I'm sitting here, and not to change topics, but I do think it is an interesting thing. We're watching DXY blast through 110, and I just quickly pulled up the euro, and there's not much going on there. It is down, of course, against the dollar today, but the Japanese yen seems to be exploding higher again, and almost 143 as we're talking, up 2 and change on the day. And this is, of course, I believe, and we've written, a sort of secondary contagion effect of the energy crisis that started in Europe, because as I'm sure everybody on the call knows, Japan is a major energy importer as well, and elevated natural gas prices in Europe get transmitted into Japanese currency weakness, in part because of their mutual dependence on the incremental barge of LNG. So I don't know how to answer that question, Alf. I mean, when I see reports of 50 to 60% of small companies in the UK claiming they'll have to shut down, you wonder, because of increased energy prices, you wonder how much of that is hyperbole, if that's actually true. Sort of what is the flow between economic slowdown, which would be massive, plus this fiscal stimulus that we're seeing to try to offset it. It's just such a complex situation that it's impossible for me to give an intelligent answer to how the market is pricing in input costs in Europe, except to say I would suppose they'll certainly be higher.
Yeah, which basically is the crux of everybody, right? To try and figure out the inputs to try and price these market variables and try to make an informed decision out of it. To go back indeed to the point is that if you don't have a view, or what I used to say a couple of months ago as well, is if you don't get commodities right, you don't get the macro right today in general, because it's very strange to have central bankers and policymakers having to react to commodity input costs to set up fiscal and monetary policy, but it is the case. This is what we're looking at today. And also what I have observed in the past couple of months is that not all commodities are behaving the same. So commodities that are at the forefront of geopolitical trouble, supply bottlenecks, tight physical markets, commodities that are not quickly replaceable, let's say, those are sometimes experiencing parabolic upward movements. Commodities that are used in industrial production, even copper, which is a bellwether actually for industrial and manufacturing production and output, they are showing a much weaker price action. This has been going on now for already 3 to 4 months, while throughout the end of 2021, beginning of 2022, the overall commodity market was just shooting higher. There has been quite an interesting divergence between commodity and commodity when looking at the price action. All of this has to be reflected to a certain extent in inflation expectations, because there is a correlation between commodity inputs and these inflation expectations, but not all commodities behave the same, right?
Yeah, this is a great point, Alf, and I've noticed the same trend, and I think it implies, at least from a high level, stagflation. One of the big price anomalies in the market that we have been following and written about a couple of times is this disparity between the price of thermal coal and the price of coking coal, which until very recently, coking coal, which is a premium product, traded for a price that was higher than standard grades of thermal coal. And that flipped pretty substantially. And there's no logical explanation for that, except that in the context of what Alf just said, perhaps coking coal, which is used predominantly to make steel, is acting more like copper, and thermal coal, which is used to make electricity, is being priced alongside of natural gas and oil to some extent. And so anytime we see a massive price inversion, like the flipping of the relative value of thermal coal and coking coal, and we can't explain it by some sort of artifact of market structure, for example. There is a deeper point being made, and I wonder whether this sort of analogy between the industrial metals and the energy input commodities going vertical is not one that might be explaining the situation here.
What are your thoughts, Jeremy? I think your desk covers commodities pretty closely, and I don't want to skip over Doomberg's question either about the whole binary event, fat tail risk, because I think we've talked about that too offline. Jeremy, would you like to comment on these 2 points?
Yeah, I mean, I think they hit the nail on the head within the manufacturing related commodities. You're seeing those definitely imply a recessionary environment, within the manufacturing and industrial world. I just saw that U.S. service ISM August service PMI beat, surprised upwards. So it seems as though that part of the economy is still somewhat resilient. Might be some outlasting effects from the pandemic, within the reopening trade there. However, I just wanted to, once again touch on Doomberg's point of the binary event here. And, Europe's issues do seem as more of, a binary event with a potential quick fix, as I touched on before, regarding tensions easing between Russia and the West. However, the part of the global macroeconomic spectrum that I can't seem to grasp my head around right now is what's going on within China. We're about 2 years removed from the pandemic, and we still have one of the world's largest economies reluctant to fully reopen, their industrial sector and their services sector. And it brings me to the fact here that I'm not necessarily sure if there's, something that goes beyond the data that market participants might be discounting. That could be something along the lines of, sufficient banking liquidity within their system to be able to, sustain a fully reopened economy. And, Doomberg, I think we've had this conversation in the past before, but I just wanted to see if, there was any developments that, you're looking at within the Eastern Hemisphere, and how its effect might be on the global environment.
Yeah, I think the developments in China, which you articulated, are the big mystery, and perhaps could be explaining even the move in the Japanese yen this morning in some convoluted way. What President Xi is doing with the, I believe they call it dynamic zero policy of COVID, is really bizarre. There's lots of sort of conspiracy theories that are being floated around to try to explain the behavior. I think it's probably not a coincidence that the upcoming Congress is very near. And there's been some, chatter out of China that perhaps Xi's position is not quite as strong as we are modeling in the West. There was some failure to applaud somebody else yesterday that I saw on Twitter as though it was supposed to be a big deal, but far be it for me to claim any particular inside baseball knowledge on the inner workings of the Communist Party of China. But presumably there could be something going on inside of China today that is being priced into the market by those who are in the know that we might be missing. And so I can't say that I have any special knowledge other than it is a very bizarre time in China. They are hugely consequential to the global economic picture, and it's going to be an incredibly interesting few weeks to see how the Party of Congress plays out, and whether Xi maintains his tight grip on power. I thought it was interesting that we saw some rumors of a potential visit to Saudi Arabia that never materialized. I'm not quite sure what to make of both the origination of that rumor and the failure of the facts to follow it. But there's no question that China is a big black box to Western observers, and anybody from the West who claims they know what's going on the inside is probably should be viewed with some trepidation in our view.
Yeah, I totally agree. I mean, if you just look at the last 30 years, much of the global growth has been, stemming from the rise of the, Chinese middle class. If you just look at their percentage of world GDP from the 1990s into, the 2020s, they've rose from about 3% to about 20% of the world's GDP. So, as a market participant, I just have to ask myself, is that sustainable? And it seems as though the CCP overestimated, the annual growth rate of how their middle class would evolve, and we're seeing that within the property market. Go ahead.
Yeah, I would just say one thing I should have mentioned that crossed the wires this morning. Of course, is the agreement between Gazprom and CNPC, a Chinese national petroleum company, on transition to basically get gas supplies through the Siberia pipeline. This is Luke Roman retweeted it earlier this morning, and his retweet was sort of in line with his thinking, which is China moving toward energy sovereignty, EU running away from it. So there is this whole growing relationship between Russia and China as well that's on the board. Many European macro analysts don't view the speed with which Russia could reestablish supply lines to be a very quick exercise. Perhaps Russia and China might just try to surprise to the upside. So there's so many moves on the board and so many sort of flows of intrigue that it's really just, as I started earlier about talking about how incredible this weekend was for European power companies, this is just really quite a time to be analyzing the markets, and it's truly unprecedented.
Yeah, no, a lot of good points there. Street Hawk, did you have a question?
Well, you guys are kind of answering my question. My question was about the state of global economy. For me, uh, the Fed basically said that they're going to be data dependent. They're not going to be on autopilot, and that means that if we are about to actually turn from inflation to slowly but maybe rather quickly to deflation. I think deflation is going to become the issue soon, and the Fed will be um, looking at the bond market. The bond market led the tightening cycle in January, and the Fed tightened into the tightening cycle initiated by the bond market. And I think the same thing is going to happen on the easing side. The bond market is going to lead and signal.
Street Hawk, do you mind DMing me your question? There's a lot of background noise.
Oh, sorry.
Or I don't know if you can step away, but it's hard to hear. But you can DM me, and I'm happy to ask Doomberg or Alf, depending on who it's for.
Is it better right now?
Yes, it is. Go ahead.
Okay. So what I was saying was that my question was about the status of the global economy, which you guys were talking about, because I think that when I look at the Fed and what they've been saying is that they're no longer on autopilot; they're going to be data dependent. And looking at what happened in January, where the bond market led the tightening cycle and the Fed tightened into it, I think the bond market will also lead the easing cycle, and the Fed will get a signal from there, and the bond market is going to look at the global economy. So if the global economy is much weaker than everybody thinks, and we're actually on the cusp of deflation, kind of like from 2008 to 2009, everyone's talking about inflation and how they're going to keep raising rates forever. But if we are actually deflation, and will the bond market signal to the Fed that, hey, look, the tightening has to stop, and also the strong dollar is damaging emerging economies, financing their debt in dollars, petrodollars. I don't want to tell you guys these things. So, are we too much focused on the consensus that the Fed is putting out in our minds, while the actual data of the global economy is pointing to deflation and a premature pause when it comes to tightening policy?
I'll try to take it despite the. I'm not sure I fully got the question, but I guess that what you want to know about is whether the bond market is receptive to a Fed-engineered harsh recession, basically. Let me put it like that. My research shows that over the last 100 years, if you ever wanted to slow inflation down from 8 to 9% all the way back to Fed target, a recession was always necessary. There's been no other instance under which inflation was able to drop so rapidly back towards the Fed target from such an elevated level without a recession. Or put another way, every time we had a recession over the last 100 years, and we started with inflation being well above the Fed target, the recession was always inevitably able to slow inflation down to 2%, or below 2%, actually, in many cases. The average recession lasted, I think, let me put it like this, the average recession slowed inflation down by 7 percentage points. It's pretty large. And this is the average harsh recession, entering one with inflation way above the Fed target. But it took also 16 months to get back to 2%. Many times you ended below that, but to get back at least to 2%, it took 16 months. The market today isn't pricing a recession. The bond market, the equity markets, the credit markets, most importantly, they aren't pricing a recession at all. They're actually flirting with the idea of a soft landing. We discussed that before, with the forward real yields being priced in the positive territory, with earnings expectations still being in the single to even double-digit positive for next year, with the bond market curve being, yes, inverted, but looking at where front-end yields are priced almost at 4%, if you expect a recession, then in year 2, 3, 4, and 5, bond yields should, be markedly lower than the 3% they're priced in today. So the bond market isn't pricing a recession. The credit market isn't pricing a recession. the equity market, neither. In some corners, you're finding some weakness being priced in, which is more than objective, I would say. But if we would have a Fed engineered by a super tight policy for a very long period, if we would have a sharp slowdown in aggregate demand being engineered by the Fed, historically speaking, this has always been able to slow inflation down markedly. And if that would happen, the bond market isn't prepared yet. If that was your question, I hope I answered it.
Yeah, you did. That was incredible. Thanks. So, following this line of reasoning that you're presenting here, if all of the tightening that's happened since January with the bond market and the Fed, do you really think that has been the impact of it has actually been felt in the real economy, or are we going to feel the impact of all of that tightening in the fall ahead of us? Like right now in Q3, Q4, we're going to feel the impact of all that tightening, and we're going to see weakness come from China and Europe, and we're going to be surprised towards deflation suddenly.
I don't think it's been fully appreciated yet, and the reason is very simple. The way through which you transmit tighter monetary policy is via tighter financial conditions, but tighter financial conditions do not affect every household, every company, every actor in the private sector the same way at the same time. What it means is that if you were a company which was smart enough in 2021 to lengthen your liability, the duration of your liabilities, so you issued long-term debt, let's say you locked in very convenient long-term capital cost and leverage cost for your business, it's unlikely that you might need to roll over this debt straight away, immediately, which means you can effectively kick the can down the road. And if your high yield borrowing costs have gone up from 4% to 9%, they've gone up only theoretically from 4% to 9% until you literally need to issue because you need the liquidity and you need to roll over your leverage and your liabilities. So there is a lag. There is no neutral rate that is valid for every actor in the economy. There are different timings when it comes to rollover. And that's why both the rate of change in financial conditions, but also the duration of this tight stance are both important to determine when and if the economy is gonna really feel the heat. And if you run some statistical analysis for how it worked in the past, both are important, the pace of change, and the pace of change has been pretty dramatic in some indicators, real yields, the dollar, in general, borrowing costs have risen pretty aggressively, valuations have gone down. So, you have had a pace of change which was very, very important, especially in the first 6 months of the year. Now it's stalled a little bit, but now we enter into the second phase, which is how long these conditions will remain tight. This is a very overlooked metric, and it is important because not every actor in the private sector has to refinance at the same time, has to go through tight financial conditions at the same time. So, long story short, I would expect that the longer conditions have to be kept tight, the higher the likelihood that a broader economic slowdown will ensue. The preliminary signs are already here, if you ask me. The shoes to drop, which haven't dropped yet, the most important is the labor market, which is holding up remarkably okay so far. It's not super strong as depicted by many policymakers, but it's holding up pretty okay. I believe that further weakness should be the path of least resistance.
Thank you for the commentary there, Alf. And I know you have to step away in a few minutes, so if before you do leave, I do want to thank you for your time and really appreciate your insights. And if you aren't following him, please give him a quick follow as well. Some great macro pieces always from Alf's handle. Doomberg, I don't know how much more time you have. We have Dr. Anas here. Maybe we can continue some more energy talk before you have to step away. But I'm not sure. I don't want to hold you up too long.
Minutes, but Dr. Anas can certainly pitch it once I do have to drop off at the bottom of the hour here. Yeah.
Yep, for sure. Alf, before you do leave, any closing thoughts or something you want to leave listeners with important to focus on in the upcoming weeks?
I would like to thank Raul for organizing the space, which has been a very interesting one, I have to say. Thanks for inviting my friend Doomberg to speak. Very valuable insights, as always, on the energy market. And thanks to everybody for listening. In case you guys want to read more, the Macro Compass is where you need to go. It's my free newsletter in case you want to check it out. Sounds a lot like a plug. It is a plug. Thanks, guys, for listening. We'll talk next time, and ciao Doomberg, ciao.
Of course, thank you, Alf, and then definitely give his handle a quick follow. Dr. Anas, I see we have you here. Any topics worth discussing? I mean, there's definitely a lot, but anything from your end, anything you're seeing, feel free to jump in.
Yes. Good morning, everyone. Those who are in North America, good morning. For those on the other side of the world, good evening. And for those in the Middle East, good afternoon. One topic, as those who are interested in the oil market know, that Saudi Aramco announced a cut in prices this morning. And I did post a coded tweet last week. I said, for those who wants to make money, increase, increase, decrease, decrease. That was a coded message for those who understood it. Basically, that OPEC cut production, and then Aramco would cut prices. Right now, this is something new in 2022. Let me go back to 2021 so we understand what's going on. We had the crisis in 2020, negative prices, low prices, etc. In 2021, two major developments in the international oil market took place. The first one is China using its SPR. They usually do not announce their SPR, but the impact was massive. The only reason why we did not get $100 oil in 2021 was Chinese SPR. And that constitutes a change in market structure. The other change in market structure is the change in OPEC and OPEC Plus attitude and behavior. And that constitutes another change in market structure. For the first time in OPEC history, we've seen large producers with large capacity adhering to their quota and not infringing on others' market share. This never happened before. This is a new development, and it seems they are sticking to it, and they are going to stick to it. That's why prices increased. Here comes 2022. We have the Russian invasion of Ukraine as a major event. The second event is the major release from the SPR in the United States, 180 million barrels. And the third development is what I'm going to talk about right now in the next 3 minutes, which is the OPEC three-leg policy. Several people ask on Twitter, what is OPEC three-leg policy? Well, this is something new. Now, if OPEC meets and decides something, don't make any decisions based on that, because this is only one out of three things you need to see. A production cut or production increase or nothing does not mean anything until we see Aramco's official selling prices. Notice that all the meetings are always a day or two before the release of the official prices. So that was intended. So first, we have to look at the results of the meeting and what it means. Remember the rules: decrease, decrease, increase, increase, at least for this time. And the second one is watch for Aramco OSP, because whatever OPEC decision is, Aramco OSP could support it or literally nullify it. We've seen the nullification of the production increase or the ceiling increase last month. Because people attribute that to Biden visit to Saudi Arabia, they did increase the ceiling by 100,000 for OPEC Plus, but then they increased prices substantially, and that nullified it, because once you increase prices, you are telling the customers not to buy from you. And if they are not buying from you, then there is no need to increase production. And then you can claim, well, there is no demand. And the third point is what they are going to supply this month. And the reason why I said the word supply, because there is a difference between production and supply. These are two different things. They could stick to OPEC production and stay with the quota, but their supplies could be way lower or way higher. And what they are going to supply is going to complete the story. These are the three-leg OPEC policy right now. So even with the changes in prices, this is not enough. We need to see, do they have, for example, additional supply to supply the market above the production, or are they going to fill in storage and therefore supply will be lower than production, or are they going to do something else if they go for maintenance and lower production while maintaining supply the same. So the whole idea here is just depending on OPEC decision is not a good approach to anything, because it means nothing until we get the other legs. That's the point I would like to mention today.
Thank you. Thank you, Doctor. We also do have a pretty big energy and oil space lined up later today at 4:30 Eastern. So I've pinned the reminder for that above in the nest. Anyone that's interested can join in. A great panel of speakers. Doomberg, I don't know if you're free, or Dr. Anas, but if you can jump in for a few minutes, even that would be, that'd be great. I think we have some great speakers there. But Doomberg, before you need to leave, any thoughts on some of the stuff that Dr. Anas mentioned?
I heard it when he said it last week, and Dr. Anas knows OPEC and OPEC Plus better than most people on the planet, and so I would concur. And I'm looking forward to seeing the supply numbers to complete the third leg of the stool here in the coming days. So, Raul, I do have to drop off. It's been a real pleasure. Thank you, and thank Alf for having me. And it's really fantastic space. And best of the rest of Tuesday to you and everybody listening. Okay.
Appreciate it, Doomberg. Thanks a lot for coming on. I think we have a couple of questions, so we can take them before we wrap here. If you're around, Dr. Anas, I think there's an energy question coming in. 1 second. Person's connecting. And just to level set for the room, we had Macro Alf and Doomberg for the first hour. Looks like Dr. Anas has a few minutes, so taking some energy questions here. This recording will be available once we end this space, so you can just go on my feed and give it a quick replay if you're interested in listening to the first hour of it. People are asking me when our next spaces is, so 4:30 today, but in general, sometimes I go on unplanned, so the only way to kind of see these spaces are if you're following our feed. So, definitely give Jeremy a quick follow, myself, and Dr. Anas. It looks like the question dropped off. Jeremy, any energy questions or anything related with like Dr. Anas's opinions before we, do wrap here?
Someone did send me a DM about a question directed to Dr. Anas, if he doesn't mind. It was just the overall mechanics of the price caps and, whether or not he thought those would have any implications to, the pricing within the futures market.
Yes, we had a whole space on this the day they announced it. So for those who are interested, they can go back and listen to the details. But since they asked, I'm going to talk about it briefly. For those who follow me on Twitter, they've seen my tweet early this morning. If the UK cannot impose a price cap on energy prices within the UK borders, how they are going to impose a price cap on someone else in the international market? That's number one. Number two, if the price cap idea is really good, why they give exemption to Japan? If it is good, should apply, and there should not be any problem. By the way, for those who are interested, I have a long thread of kind of comic things on this. Probably many of you have seen that. I'm sorry. I mean, I have a great respect for Yellen, but to get involved, she failed, as you know, miserably on inflation, and all of a sudden she's an oil expert right now. So the whole idea of price cap is based on the idea that historically governments within their own countries impose price caps, including the United States of America in the 70s. They had the legal power, they have the police, they have the court system, and they have the punishment mechanism. And for some reason, they think they can take this application, which within a country's border, and do it globally on something else, which does not make any sense at all. First of all, they don't have enough to monitor and enforce. If you look at the press release of the G7, they are talking about every single tanker in the world carrying Russian oil has to verify, first of all, the origination of it that's coming from Russia. And then they have to show a piece of paper from a bank showing the price they paid. I mean, I made the joke about the IRS in the new bill hiring 87,000 IRS inspectors. Probably they need another 87,000 inspectors just to monitor those ships. On certificate of origination, look at Iran. They've been changing it for years. In terms of price, you can make up any piece of paper on price. Even if you do it right, you can pay money under the table. And that's why in the comic that I posted, I mentioned the movie Syriana, because it tells you a lot of what goes under the table. And those finance ministers basically, it seems like they are not aware of what goes under the table and the black market. The other issue with it is, okay, I am from Western Europe, and I just bought a couple of million barrels of oil from Russia, and now I need to pay Russia. Well, guess what? I cannot pay. Because of the sanctions, I cannot pay. So how the Russians are going to get paid? And of course, there are many things you can look into that space. But the final point is, it all depends on one thing. Are the Russians willing to sell? If they are not willing to sell, then there is nothing there. To conclude this, why are the G7 members why do they want to impose a price ceiling on Russian oil? Either because Russia is able to sell its oil anyway in the market, so they think they cannot control exports, and therefore they want to control prices. Well, the fact of life is, if you cannot control exports, you cannot control prices. Or, and that's the other option, that they need the Russian oil. And if they need the Russian oil, this negates the whole idea, because if Putin knows they need his oil, all he got to do is just cut it. So any way you look at it, it does not make sense. And I urge you all to check the comic things on my Twitter account, because you'll laugh. Back to you.
Thank you, Dr. Lati. Go ahead.
Good afternoon, people. I'm Sati Madela calling from South Africa. I just got a general question on 2 questions on energy. My first question on energy. Do you world superpowers ever think about African countries when you go on about decisions amongst yourself that increase the cost of energy? Second question is, do you people, or how can you help or even be part of the conversation? Because certainly in my country, in South Africa, where I see it, we've had this ambush from the German people wanting to subject our nation to the renewable energy that doesn't work here for wind and solar at the expense of shutting down our coal plants and refusing us to build nuclear power plants. And yet the minute Germany had a problem with the energy crisis, they came flying to South Africa to come and get our coal at all costs. And therefore now they are banning coal, and yet our president and our government is being told, shut down the coal when we have 200 years of coal underground, and when we are the best country in Africa to have any prospect of having a nuclear power plant. These things are being refused to us. I want to ask the question, do you people even think about the African countries when you go up on about these decisions? Because certainly it doesn't go down well with me that when Germany was in trouble, it never forgot to quickly come to South Africa and buy coal and the way it wished. Now it's banning coal, the very same coal that it's been asking our government or advising our government to stay away from. That's my question. Thank you.
Thank you,
Raul?
Before you answer, Dr. Anas, I don't think any of us are involved in any decision making from a congressional level or policy making standpoint. I wouldn't call us you people. I mean, I don't think I have any direct impact in any decision that our governments make. I'm sure Dr. Anas and Jeremy Lin are in the same boat. So that's first things first. But I don't know if you have any comments on the
Yes,
situation.
Raul, we have our friend from Saudi Arabia who is an advisor, he is an investor, and he's an expert on investment in Africa. Our friend Eid Al-Eid from Saudi Arabia, probably he can talk about investment in Africa, especially in the energy sector. I don't know if you see him, Raul. Do you see him?
No.
He's with the Saudi garb. His name starts with EID.
EID. No, there's thousands of people here. Oh, I see him. I see him. Yeah, if you want to tell him.
Please, will you raise your hand so he can see you, please?
No, I see him. I
You
sent him
see
an
him?
invite
Okay.
to speak.
He's
Yeah,
an expert and he's an investor in Africa.
yeah, he would have to accept to speak, but I do see him. I sent him an invite. So
Okay. Just one comment until he shows up on Africa. Basically, one of the problems is Africa is two parts. The first part is that those who believed in what Europe is calling for when it comes to climate change, and those who do not believe in it, there is a strong opposition to that. But for those who believed in it, basically they are really making a big mistake because it does not suit them in terms of the phase of economic development they are in. I think Aid is there. I'll let him speak.
Thank you, Mr. Ernest. Thank you, Mr. Raul. Regarding to the investment in Africa, I think there is a lot of problems that we faced in Africa. One of them is I want to talking about what the European and the American or Western talking about Africa. They talking about there is a lot of problem and they make a bad picture about the investment in Africa. This is one problem. The other one is the mentality of the African people. We faced a lot of problem with them, but there is a lot of benefit, a lot of opportunity in Africa, and I think we are looking for a lot of. We are looking for to change some ideas with African to give a chance for the Saudi Arabia and the Gulf state to get inside in the Africa. One of the problem that now they are faced is with the European. It's about the weather, or what do you say it, Dr. Anas, as we talking yesterday, most of them now, they can't to invite the investors to invest in the hydrocarbon because they can't to facing the problem with the Western people, they will make it. This is one of the big problem. But I think now some of the countries like Congo, Democratic Republic of Congo, the president, he say, we are looking for our people. Still, we are a poor country, and we have to looking for any chance to work with the investor in any field to make a benefit for our people. Yes.
all right, thank you, Eid. Sugar, what's going on?
Thank you, Rahul, for the space. There was a question for Dr. Al-Haji. Basically, oil gets smuggled out of the Niger Delta illegally. It's a risky business, but it happens. However, the banks don't finance it, and it becomes very difficult for that oil to be sold. So concerning the Russian oil and the price caps and other sanctions, Dr. Al-Haji mentioned it's going to be difficult enforcing it. But my question to him is, isn't the actual decision or any legislation the biggest deterrent, in the sense that trading Russian oil becomes on par with oil stolen from the Niger Delta, in the sense that it's risky business shipping it out when it can just get seized? So the question is, isn't the legislation itself more or less sufficient deterrent and does most of the job? Thank you.
If you want to talk about legal issues, first of all, you cannot compare the Russian oil to the stolen oil in the Niger Delta. The Niger Delta, that oil is literally stolen. Russians are selling their oil. This is not a stolen oil. So legally, there is no comparison here. You want to compare it, you can compare it to Iran and Venezuela, the way they are trying to sell their oil in the market. But once you talk about the legal issues, here is another one I did not talk about. Who gave the G7 the authority globally to control the global oil market and the flow out of Russia? They have no legal authority. They were not authorized by the United Nations. They were not authorized by the UN Security Council. So we want to talk about legal issues. What legal issues they have? They have no legal authority to talk about the global fleet of tankers. None. They want to control things within their own borders or their own waters, yes. But they have literally no legal authority to say what they said in that press release. Back to you, Raul.
I wasn't comparing it directly with stolen Niger Delta oil from the Niger Delta. I was comparing it in the sense that it's almost impossible to get any financing on oil that's come out of the Niger Delta because of proof origin, etc. So there was a similarity in that sense. So my question was more to do with the fact that not what right does the G7 have to impose any price caps or any other restrictions, but isn't such legislation or aren't such decisions sufficient to do the job in the sense that shipping, bankers, traders will simply be will be deterred from trading Russian oil. It becomes risky business taking out Russian oil.
Yes, that's why I mentioned Iran and Venezuela. Compare it to those two countries, even to Syria, even to Sudan. They were able to ship whatever they want to ship, despite all the sanctions on them and all the sanctions on Iran. Iran is shipping a lot of oil, and they've been shipping a lot of oil since Trump returned the sanctions on Iran in the fourth quarter of 2018. So it has no impact. What the impact basically will be that there will be a discount. So the Russians are not going to get $100 for every barrel of oil. They are getting about 70 or 65. That's the impact. But they will ship their oil no matter what.
So do you think any discount that might occur will be the equivalent of the price cap that the G7 wants to put
This
on?
is one of the jokes about the cap, because if they are going to set the cap equal to the range of the discounted price, then why you are going to go for the cap? They are going for the cap because we in the United States, remember the US is pushing for it, and Yellen in particular. They are pushing for it because the Biden administration want to show something before the elections. Think about it this way. Even if you assume, and I hate those assumptions because I think those scenarios, I really don't like them, but I have to say it to illustrate a point. Assume that they are able to do something with this price cap. To set up the system, you need at least 9 months to a year to set up the system. But the Biden administration won that before November. So it is something just on paper. It is a toothless thing. Back to you, Raul.
How effective do you think the two will be? Namely, one, their decision as a deterrent from trading Russian oil. Two, the cap more or less acting like the equivalent of a discount. Do you think neither will be effective or partly effective?
0.
Great.
All right. Thank you, Doctor. Philip, go ahead.
We don't hear you, Raul.
Can you hear me now?
Yes.
Yep.
Hey, Philip, go ahead.
Thank you, Raul. Great space, and Dr. Nas, as always, it's an honor to hear your commentary on the markets. My question is really taking a step back and looking at the bigger geopolitical implications vis-a-vis the war in Russia and Ukraine, and then of course the tensions in the Far East with China and Taiwan. And I think about the longer game that the U.S. A lot of us think our U.S. politicians are inept, and largely I tend to agree. But I'm hopeful that there's some people in positions of power, whether it's the intelligence services or other parts of the administration, that actually know what they're doing. And so my question for you is, when you look at some of the things that are happening to constrain Russians' ability to move their oil, is there a point at which that Russia will have to shut in their gas wells and or oil wells? And so, A, do you think that's part of the longer term strategy? And B, do you think that it could be effective over some period of time?
Doctor, are you there?
Sorry, I did not notice this was muted. This is a good question. The answer to it is too long, so I'll try to say it in like the most condensed way possible. First of all, most of the impact on Russia happened because Russia was trying to preempt the sanctions and what Europe is doing, not because of the sanctions. So all the switching, the discounts, etc., some of it basically is related to the Russian behavior in trying to preempt further actions by the Europeans and the Biden administration. Let's look at the sanctions because this is really people must understand this. Remember, there are people who expected that Russian production will be 2 to 3 million barrels less than today. And it did not happen. Why? Well, first of all, let's start with the beginning from early March. Justin Trudeau, the Prime Minister of Canada, announced that he is going to punish Russia by stopping imports of crude oil from Russia. Well, guess what? Canada does not import crude oil from Russia. The Prime Minister of the UK announced that he is going to stop oil imports from Russia. And the press went crazy and made him a hero. But if you look at the actual statement, he said, by the way, by the end of the year. Look at President Biden. President Biden said that we stopped or we kicked out Russian banks from the SWIFT system. That was absolutely incorrect statement. It was some Russian banks that are irrelevant to international trade. Shell, the company, the oil company, announced that they are going to stop trading and buying Russian oil. Go back to their website and you will see the fine print. Only in the spot market. And the list goes on and on and on. Even the service companies, what they said, people think they left Russia. They did not leave Russia because their announcement, if you look at the fine print, they are stopping new investment. And the word new, I mean, it has many legal terminologies here. The oil companies that want to exit Russia, ExxonMobil and BP, they've been trying to exit Russia for the last 15 years. BP is going to exit now because they get compensation from the government because of the sanctions. So if you look at the sanctions, basically they were not effective from day one. And it is, everyone knows in politics today, you do not want to corner, you want to hurt Putin, but you don't want to corner him, because if you corner him, the whole world is going to pay a price. If he cuts oil exports, if he cuts natural gas exports to Europe, the whole world is going to suffer, and he can wreak havoc on the world economy. So they want to hurt him, but they don't want to corner him in this case. Let's say that they start shutting down production. We've seen this before in Venezuela. We've seen it in Iran. We've seen it in Syria. If once they start shutting down production and they close the oil wells, this is God sent gift to them. I'm not talking about prices, but if they cannot get spare parts, now they start the process of cannibalization of the shutdown wells. And the Iranians perfected this system, and which wells to be shut down, which well to be cannibalized, so they can use the spare parts. They can survive probably about 2-3 years just using the spare parts of the cannibalized wells. And that means all those forecasts about a major decline in Russian oil production or gas production in the next few years is unfounded if you look at the process of what happened in other countries and what happens on the ground. Back to you, Raul.
Thank you, Doctor. Oil Mark, go ahead.
Hey guys, thanks for having me. I was actually curious, Dr. Anas, have you been keeping up with the Iraqi oil field sale from Exxon to the Iraqi, I think it's Basra? And I was curious it shows it's only going for like $300 million. But do you have any thoughts on that? Is it expected to close soon, or?
Yeah, but remember, the Iraqi constitution prohibits profit sharing contracts. So whatever Exxon is going to sell is just equipment.
Oh
There is no
wow!
oil.
So 20 billion barrels, they don't get any part of that. It's just the
Nothing.
equipment.
Zero. Because they
Wow.
don't own anything.
Gotcha. All right.
Is
Thank you,
that
sir.
clear?
Thank you, Wilma. Let's see. It's like there's too many questions to answer. I'll say this, Doctor. Anything. So we have another space at 4:30, which I want to save some oil and energy questions for there. So if we don't get to you now, you can join in. It's pinned above the reminder. We have a great set of speakers there as well. Doctor, I don't know if you're free later, but feel free to jump in that as well. A lot of energy stewards are coming to that as well. Any closing thoughts, Doctor, from your end on the given situation that we've seen? I mean, we had Doomberg and Alf on for the first hour. So if anyone wants to listen to that, I mean, once I end this space, you'll be able to catch the recording on my feed. But anything, just given the current situation, I've written a thread on the crisis. It's also on my feed, which I think is pretty helpful, simplified view on what's going on. But anything from your perspective, Doctor, worth noting or just trying to follow?
It's a question for me?
Yeah, just
Okay.
overall.
Okay. The policy was clear from day one. And if you go back to the spaces we had in March, it was very clear that Putin is going to starve Europe or gas starve Europe, but he is not going to kill Europe. And as the Biden administration understood this, the Biden administration directed all resources to try to build the storage in Europe, to build the gas storage and direct all the oil supplies to Europe to the extent that they ignored U.S. sanctions on Iran and Venezuela. They allowed European companies to import oil from Venezuela despite the sanctions. They did not lift the sanctions, but they give them an exemption. And they literally give the green light to Iran to sell in Europe. And Iranian oil is sold publicly in Europe today with the blessing of the Biden administration. So all the efforts basically is really to stock up on oil and gas in Europe. And as the gas storage increased, one of the mistakes that those countries and the EU did, including the IEA, and I seriously think, and I'm saying this publicly, the IEA guys should keep their mouth shut because they are part of the problem. They caused this problem, and all of a sudden they are attacking others, blaming them for the problem. They are the cause of the problem. They ignored energy. It is the International Energy Agency, so the word energy is in the middle, in the heart of it, and they changed it to International Environmental Agency. So everyone is paying the price for that. But what they do is they keep announcing the increase in the storage level. And every time they make an announcement, Putin retaliates. So they should have kept their mouth shut, build their own gas storage without telling anyone. So that would be good for them and good for national security, good for energy security. But no, they have to announce it every couple of days. And Putin retaliates every time they announce that. So what we have right now is even if the European storage is full, this is only about a quarter of what the Europeans need, which means that if Russia cut its supplies in the middle of the winter, they are doomed no matter what. The only difference here is this: because they decided to go back to coal and they decided to push for conservation measures that made the life of Europeans similar to the people in the third world countries, they are going to succeed in improving the situation in Europe from a disaster to a crisis. This is just reminds me of the efforts that we made when they say we prevented famine in Africa and we made them poor. Poor means that this is higher than famine, so it's better. The same thing right here with Europe, that we are not going to have this. It's not going to be the worst case scenario. It's going to be a little bit better, but still, it's going to be a big problem. I don't know what's going to happen, but it is very clear that whatever conservation measures are being used today are going to. Let's look at it this way: whatever conservation measures they have today, they are still in heaven. If you go back to 1973 and look at the measures that have been adopted because of the crisis at that time, we are not at that level yet, and this is going to be way worse than 1973. Back to you.
Thank you, Doctor. Adam Townsend, did you have a question, comment?
I do, and thank you so much for taking this call. In terms of, and Anas, thank you so much. You've made yourself very available. In terms of the propaganda effects of this, of course, what I see is mostly from the West. I also have a good perspective into India, which is where I have my businesses and speak with them daily. What is the effect of the propaganda implications outside of the Western environment that I'm seeing?
Doctor, I think you're on mute.
I don't want to make this personal, but this answers you will answer you perfectly. That there are several people, including me, whom you don't see on mainstream media at all because of what we are saying on Twitter. I get private messages from journalists in top newspapers in the world who say, we really like this, we want to cover it, but our editors told us not to do. Back to you.
Avi, any questions from your end?
No, I'm just listening. This is phenomenal. Thanks for putting this on, Rahul. I'll come up with a question here in a minute, but I'm really enjoying these speakers.
All right, thank you, Avi. Benjamin, you have a question. Benjamin, go ahead.
Sorry, I'm in public transport, but I sent you a message by private message. I wonder if you could ask Mr. Anas for that.
I can't hear you, Benjamin. Your mic's pretty low.
Thanks.
All right, let's let him figure out his mic. Global macro.
Thanks very much for the space and the opportunity to speak. I just came back from 7 countries in Eastern Europe. This is my second tour since June for All for Business. The prior speaker, I think it was Mr. Townsend, is it Adam? Sorry, asked a very, very good question. I can tell you, I probably spoke to dozens of business leaders over the last 3 weeks. Not one of them, not one buys the nonsense coming out of the West. In fact, they're livid because they're very, very concerned about what's going to happen. Specifically, countries that are most impacted are Eastern Europe that don't have the budgets and certainly don't have the largesse of GDP in order to find ways to manage the energy concerns that they do have in terms of driving more subsidies. Businesses are incredibly concerned. I've seen several factories where the year over year, in terms of just pure electricity, has gone 3 times. So we're talking about firms that are spending a year ago €1 million per month on hydro. So these are very large companies, are now paying €3 million a month. But I can tell you from a political perspective, and again, my questions were very honest, incredibly sincere in terms of what they found, what they saw, and how they feel about all of this. And I can tell you that not one, I wish I had found one leader to come to me and say that they believe the whole notion of how the West has painted this, but no one believes it. They think, in fact, it's a lot of bullshit. And they're very concerned about the winter, especially Germany, because they really are the GDP powerhouse at $3 trillion for Europe, and all things lead to Germany. I can tell you, a week and a half ago, I was crossing the border from Bulgaria to Romania. there was 22 kilometers. Okay, get this, think about this, 20 kilometers, 2 lanes full of trucks, one after the other, all bypassing because of the war. The entire supply chain into Central Europe is an absolute disaster. So if I didn't see it with my own eyes and if I didn't take pictures, I would have thought it was bullshit. But I can tell you that a lot of large companies that have been doing business in the Ukraine, Russia, Central Europe, and feeding Germany, it's a goddamn mess. So um, I think the question that I keep wondering is, um, you know, who's going to pay for this? What's the grand deal behind all of this? Because I'm going to tell you, Eastern Europe and Central Europe are going to have one hell of a time. I'm still in Europe. I've been here 2 months. And unless you come here on the ground and you see what's happening, because I can tell you that they are hoarding coal, they are hoarding wood. People that can and factories that can are doing so. They're shutting down third shifts. They're going to two. Some are going to 1 10-hour day. So if you think that GDP is going to stand in Q4, people are dreaming. And Europe is the largest economy in the world. I think so. I think you need to be here on the ground and do a tour and truly understand the implications, because energy insecurity is alive and well. And this is not I'm not trying to dramatize it. Um, I saw it with my own eyes. And I've been doing business in Europe for 30 years. Never have I seen anything as crazy as this. Over to you.
Doctor, any comments on this?
No, I mean, I think he is right. He's been on the ground, and this is exactly what we've been hearing. But the way he described it is more credible than us talking about it from far away. So he's right.
Yeah, no, you certainly have some major challenges there, and I think the point you made about Germany is very key. I mean, that's the country closest to the Nord Stream, right? And they're kind of stuck in a massive situation. I have a thread on this as well. Uh, yeah, I've pinned it above. You can see kind of what's going on with the nuclear power plants there. And you also have an ECB decision due Thursday. So a lot going on in Europe, and I think this energy crisis is certainly going to be something that has lasting effects for probably months, if not even a longer time. I don't know what you feel about that, Doctor. Go ahead, Global. Global, did you have something? You're on mute. One second. We have a couple speakers requesting.
Did you want me to finish that? Sorry, I don't know why I went off.
Yes, go ahead. Go ahead.
The only thing, yeah.
Actually, I do live in Europe. Just
1 second, George. Let Global finish, then you can go next. Go ahead, Global.
The only thing I'll stress is that the supply chains going into Central Europe remain incredibly stressed. I worry about, I guess you guys may have talked about the whole inflation story. Inflation is very much alive and well in Europe, and likely going to be sustained for quite some time because of the supply side. I won't even get onto the demand side. Let's just leave that out for a moment. But the supply side constraints and issues, especially around additive costs in order to get to their respective destinations in time, is really what's adding more jet fuel to the whole inflation story. And here's the irony. The irony is that at the same time, the economies are slowly rolling over in terms of PMI. So if you look at their PMIs, they're all slowly, turning over. The other thing I'll mention is that Q4, the general mentality that I'm finding here is one of conservation, is one of okay, we need to somehow mitigate and manage our requirements, and I'm talking about business requirements, including consumer. But let's just stick to business for the moment. In terms of how can we somehow manage to stay relevant in the market, continue to export, because Germany, as many of you would know, I mean, I've been doing business there for 30 years. The majority of companies under 1,000 people, their target markets are outside of Germany. They're an export machine. That's essentially how they manage, how they live. They have a real problem. So the emphasis is around energy insecurity, supply chain shocks that will continue, and inflationary pressures that will continue as a consequence of ongoing, supply shortages that likely are going to continue, given what I'm seeing and given the delays that I'm seeing in the sectors that I cover. Over to you.
Thank you. Go ahead, George.
Yeah, I just want to comment on what the speaker said about Europe. So, what I noticed, because I do live in Poland in Europe, so we are kind of a border country to Ukraine, and we have already 3 million refugees or so. So you could imagine the impact of this on the state budget. So I just noticed there's way too much doom and gloom. Everyone is calling for doom and gloom, negative media, gas going over the roof, saving account being depleted. But with all this being said, I could notice that life is going on really normal. Unemployment at all-time low. Everyone in Europe has a job. Everyone has a shelter. Yes, we're gonna get ahead when it comes. I hope the winter will not be that harsh. But yes, we will pay maybe 3 times more for energy. But you guys, maybe I don't agree with all this dark picture that everyone is trying to paint over Europe, because it seems to me that we're gonna get out of this, let's say, unscathed. Thank you.
Okay, totally fine. And I think, yeah, that's the whole point of this space, is to have opinions and conversation about the different situations going on. So thanks for your perspective as well. Quick question for you, Doctor, coming in from Benjamin Levine. He's having a hard time connecting, so he asked me to ask you, can you ask Dr. Anas about whether Russia can maintain production through winter with challenges related to winter permafrost? This relates to one of Zehan's claims that without Western engineering support and parts, Siberian production could be permanently curtailed. Any thoughts there, Doctor?
How many times we heard this in recent years? We've been hearing about this since 2014, and we heard about it in 2009, and nothing happened. Back to you.
So no impact. Okay.
Can I add to that if you don't mind?
Go ahead, Oil. Yeah.
If they potentially did have to shut in wells, there are chemical treatments you can put in it for shut-in purposes to keep it from damaging the wellbore. So even if they did, and they have in the past, it's a simple chemical treatment and negates basically all the potential problems. So even hypothetically, if they did, they know enough of what they're doing not to just kill the revenue. So that's I think it's really a non-issue in my opinion. But just wanted to add that from an oil field standpoint.
Thank you, Oil. Benjamin, are you back, or is your speaker working?
I'll be back in about 5 minutes. Sorry for the wait. Thank you.
Okay. Matthew, Detective Matthew, did you have
Yes, thank you very much for the mic. Just a quick question for the whole panel, actually. I'd like to hear some perspective on this. What if an energy crisis, it's Europe? Could it play in favor, sort of could it play in favor of France and Russia getting closer to one another and sort of drifting away from the NATO alliance a little bit? Is that a way this could play out, sort of in favor of more independence to France, or is the U.S. going to reap most of the rewards from a situation like that?
Can I answer that question? It's global
Yeah, go ahead.
macro. The U.S. has already reaped the disproportionate rewards of this conflict. Look at all of the contracts that have been awarded for the military alone. Germany's spending over $100 billion in new military. Greece has just spent over $20 billion over the last 18 months, primarily to threats because of Turkey, but nonetheless, the major manufacturers are essentially the F-35 program. The same thing is happening throughout the rest of Europe as the policy was send all of the Russian-made stuff to the Ukraine, and it will be replaced with new product coming out of the United States. The U.S. has already won. They are the disproportionate winner, and they will continue to be the disproportionate winner with this conflict without ever having to sacrifice one human American life in the process. Well done.
Well, what about? Don't you think there's a possibility that Europeans, and I'm talking sort of about the educated masses, let's say, will sort of blame the U.S. for what's happening? Like what I'm hearing from the people I know over there is that the bills for energy are getting pretty crazy. Isn't there a possibility that it will shift public opinion, against the U.S. and towards, I guess, um, uh, more of a desire for
It already
European strategic independence?
to people, you talk to businesses, you talk to
You're cutting off a little bit. I cannot hear you properly.
I think we lost him. Go ahead though, Matthew. Did you have a question or just a comment? I'm not sure.
No, I had no follow-up question, but I'd like to hear the perspective of people on the panel if they have any.
Sure, Doctor. Any other thoughts there?
I really, I do not like playing with hypothetical situations, but let me give you the main idea here. What Putin wants is to strangle Europe enough to force a crack in the EU, where some countries, publicly or under the table, will play with him, and they will deal with him. And the Biden administration understand that, so their job is to prevent that. And to prevent that, that means they need to direct all the energy sources toward Europe, so Putin will not be able to strangle Europe. And that's why, if you listen to what President Biden said during the NATO summit a couple of months ago, when a journalist asked him a question, he said the meaning of it, of course, I'm not quoting him here. The meaning of it is even if Americans suffer from higher natural gas prices and higher fuel prices, it's worth it as long as they stop Putin. So the game is very clear from a Putin point of view and from the Biden administration point of view. And whatever happens in the rest of the world doesn't matter anymore. Back to you, Raul.
Thank you, Doctor. Benjamin, your hands up. Are you back? It looks like he's not. Okay, third.
Yeah, sorry. Thanks for the wait as well. To add to the what the doctor just said as well, is here in the EU, there's also a kind of a consensus like do whatever it takes just to hurt him and don't look back at what side effects it brings. And that is kind of the consensus, even though that we do see rising electricity prices for homeowners. But I don't think they are like connecting the dots that, oh wait, we've also been not investing in oil and gas, and still would rather blame Putin or Russia for what they are doing. And we don't have a lot of self-criticism within the EU, to be honest, and that's kind of been a getting lazy of being too rich or something, in my opinion. So that's just a tad bit I wanted to add, to bring back something which Doctor said before. It was about the oil cut from OPEC from 2 days ago. I just saw on Twitter that they've released higher oil prices. If I could get some clarity, does that mean that it is followed through, so we will have less oil get produced? Thank you so much for the wait and the time.
The announcement of the increase of 100,000 barrels a day last month, and now the retraction of that, in both ways, it has no impact, because this was an increase and a decrease to the ceiling, and they are not producing at the ceiling. They are producing way below that. I mean, way like probably 2.7 million barrels a day below that ceiling. So the impact either way is almost nothing, and has no impact. So the reduction is from the target, or from the ceiling, not from the actual production. Back to you, Raul.
Thank you, Doctor.
Can I add something?
Right. I think we're gonna call it here. We've been going for a couple hours now. We do have another space at 4:30 Eastern, so in a few hours. Big shout out to Pounding the Table. I'm always on spaces between my handle and PTT's. So, I'd give both a follow if you're interested in these spaces. If you're a lot of people are asking me for the recording. Once I click end on this, you'll be able to go on my feed and click play. The first hour, if you missed, we did have Macro Alf and Doomberg. The second hour was covered by Dr. Nas. Like I mentioned, we have another space at 4:30 Eastern, which I'm pinning above right now. So if you want to set your reminders, it's pinned above in the nest. The easiest way to stay in tune with these is if you're following us. So I would, give Dr. Anas a follow. Avi, Pounding the Table. Doctor, I don't know if you're free at 4:30, but we have Dr. Sarah, Josh Young, Oil Mutt will be there, Benjamin Levine. So many great speakers at 4:30. If you can stop by, we can focus a little bit more on energy. And again, anyone that missed, I think there's like 20 plus questions. So we can try to cover that later this afternoon. Avi, any other closing thoughts before we wrap here? Dr. Anas, anything?
No, I just think I just want to say thank you. You do a phenomenal job, and you earned yourself. I'm going to block off time on my calendar now for 4:30, so I'm excited for this one.
Thank you, Dr. Anas. Anything from your end before we wrap?